Sam quits his job to start a business. Derek asks for a promotion and gets it. They both think they made the smarter move. They're both wrong, because one of them forgot to count the years it takes to survive, and the other forgot to count the ceiling above their head. And when you actually run the numbers over 20 years, the gap will make you rethink everything. Let's keep this fair. Sam and Derek both earn $65,000 a year. They're both 28. Same city, same savings of $40,000, same ambition. The only difference is what they do next. Sam puts his $40,000 into launching a small online business, a niche e-commerce brand selling specialty fitness gear. He quits his job on a Friday. He has 6 months of runway. He tells himself that's enough. Derek stays. He negotiates a promotion to senior analyst. His salary jumps to $78,000. He takes $10,000 of his savings and puts it into an index fund. He goes back to work on Monday. On day one, Sam has a logo, a Shopify store, and a story that sounds incredible at dinner. Derek has a $13,000 raise and nobody to tell. It's not even close in terms of how it feels. But feelings and math are two very different things. For the first year, Sam is building. He's pulling 60-hour weeks, product sourcing, customer service, running ads, writing copy, handling returns. Revenue in month 1 is $3,200. Month 3 is $7,800. Month 6, he's at $11,000. He feels the momentum. He's not paying himself yet. Everything goes back into inventory and ads. But the growth feels like proof that he made the right call. Derek, meanwhile, is doing his job. He gets his paycheck. He puts $500 a month into his index fund automatically. His coworkers complain about office politics at lunch. He nods, eats his sandwich, and goes back to his desk. Nobody is impressed. By the end of year 1, Sam has generated $94,000 in revenue. He's also spent $71,000. Inventory, ads, software, shipping, contractor costs, and one catastrophic return situation in November that wiped out his holiday margin. His actual take-home, $11,000 for the year. He worked roughly 3,000 hours to make it. Derek earned $78,000, put $6,000 into his index fund on top of the initial $10,000, and his portfolio is now sitting at about $18,000. He worked 2,000 hours, he paid his rent, he went on one vacation. Sam is not losing, but he's also not winning yet. And almost nobody tells you that year 1 in a real business almost always looks like this. Here's what nobody puts in the business launch highlight reel. The first cost is your own salary, or rather, the absence of it. Sam made $11,000 in year 1. He used to make $65,000. That $54,000 gap is an invisible expense that doesn't show up on any profit and loss statement, but it absolutely shows up in your bank account. The second cost is the failure rate. According to the Bureau of Labor Statistics, roughly 20% of small businesses fail in year 1. Around 45% are gone by year 5. Sam is in the 80% who survive year 1, but survival and success are not the same number. The third cost is the ceiling illusion. Every entrepreneur believes they're the exception. Sometimes they're right. Usually, the timeline to that exception is 3 to 5 years longer than they planned. By year 3, Sam's business has found its rhythm. Monthly revenue is consistently between $18,000 and $22,000. He's hired one part-time contractor. He's paying himself $48,000 a year. He's profitable. He has a brand, repeat customers, and a supplier relationship that gives him better margins than he had at launch. But he's also 3 years into a business that hasn't paid him what his old job paid him yet, and he's still working 50-hour weeks. Derek got promoted again, this time to lead analyst at $94,000. His portfolio, with consistent monthly contributions and roughly 10% average annual return, is now worth approximately $52,000. He's working 40-hour weeks. He took 2 vacations this year. He does not think about work on weekends. This is the part that makes the business case genuinely hard to look at clearly. On paper, Sam is building something that could be worth 10 times what Derek has. But he's also 3 years behind on savings. 3 years into a personal income that still hasn't caught up to his old salary. And the business lives or dies on decisions he makes every single week. Derek's portfolio grows whether he makes good decisions or bad ones this quarter. By year 5, Sam's business is generating $280,000 in annual revenue. His take-home after expenses and federal and state taxes is about $75,000. That's more than his old salary. Finally, his business, if valued conservatively at 2 times annual profit, is worth somewhere between $150,000 and $200,000 on paper. That's real wealth creation, but it's locked inside a business that requires him to show up. Derek is earning $105,000 after 2 more promotions. His portfolio is sitting at approximately $105,000. He has also maxed his 401k for the past 3 years, contributing the IRS limit of $22,500 per year, which Sam has not done, adding another $18,000 in tax-advantaged growth he doesn't have. His employer matches 4%, which is another $4,200 a year that Sam is leaving entirely on the table. At year 5, Derek has more liquid, accessible wealth. Sam has more total theoretical wealth, but his requires a buyer to be real. This is where the story depends entirely on what Sam does next. If he sells the business at year 7 for $400,000, a realistic number if revenue keeps growing and he's built systems that don't require him, he walks away with more money than Derek will accumulate in another decade of working. One liquidity event changes the entire math. If he hits a wall, a competitor undercuts him on Amazon, a supplier relationship breaks down, one bad product cycle drains his cash reserves, he might spend years treading water at $60,000 to $70,000 personal income with a business that looks valuable but can't be sold and can't run without him. That's not a company. That's a job with extra steps. By year 10, if everything goes right for Sam, he's built a brand worth $600,000 to $800,000 and is paying himself $120,000 a year. His total wealth, including the business valuation, is somewhere between $700,000 and $900,000. He got there by outworking every scenario that tried to stop him. Derek's portfolio at year 10, with increasing contributions as his salary grew, is sitting at approximately $230,000 to $260,000. His net worth, including his 401k and employer match, is approaching $350,000. He did not sacrifice a single weekend for it. At year 10, Sam is likely ahead in total theoretical net worth. Derek is ahead in liquidity, stability, and hours of his life he kept. By year 20, the gap is enormous, in both directions. If Sam built and scaled a real business, he could be sitting on $2 million to $5 million in business equity, a solid salary, and potentially passive income from a brand that runs without him. Entrepreneurship, when it works, creates wealth at a speed and scale that a W-2 salary can almost never match. The top 10% of small business owners don't just beat salaried employees over 20 years. They make them look like they were playing a different game. Derek, with a strong career trajectory and consistent investing, is sitting on approximately $550,000 to $650,000 in his portfolio. Solid, real, tax-advantaged, not subject to a single supplier relationship or Google algorithm update destroying it overnight. He can retire early, coast, or pivot into something new. He has options. But here is the comparison nobody wants to sit with. If Sam's business hits a ceiling at year 5 and never breaks through, if he earns $70,000 a year for 20 years and the business never becomes sellable, his total wealth at year 20 might be $200,000 to $300,000, less than Derek, with more hours, more stress, and more exposure. No 401k match, no employer-sponsored health insurance, no paid time off. Every dollar of protection that Derek's job handed him automatically, Sam had to buy out of pocket. The salary path doesn't just offer stability, it offers compounding, on time, on money, on career capital. Every promotion Derek earned made the next one more likely. Every year of contributions made the next year's returns larger. He wasn't standing still. He was climbing a different kind of ladder. Both paths have real risks that people refuse to say out loud. The business path, most businesses don't scale. Most founders underestimate how long it takes to pay themselves what they made before. The income volatility is real. One bad quarter can undo 2 good ones. And the risk isn't spread across thousands of companies the way a total market index fund spreads it. It's concentrated entirely in you, your decisions, and your market. The salary path. Your income is capped by what someone else decides you're worth. Layoffs are real, and a $650,000 portfolio at 50 doesn't protect you if your entire industry restructures and you can't find equivalent work. You build wealth for yourself, but you build leverage for your employer. And there is a ceiling. At some point, the next promotion stops coming. Sam and Derek both made a reasonable bet. What neither of them did was sit down and honestly map what success and failure actually look like over 20 years. Not the best case, not the worst case, but the realistic case, before they made their choice. The real trap isn't entrepreneurship, and it isn't employment. The real trap is choosing either one because it sounded brave, or safe, or impressive, without asking what it costs in years, in risk, and in the life you're actually living while the math plays out. And if you're wondering what happens when you build a business and stay invested in the market at the same time, when Sam never stopped contributing to a SEP IRA even in the lean years, that's a completely different conversation. And the math might change everything you think you know. But for now, the next time someone tells you entrepreneurship always wins, or a stable career always wins, ask them one question. Did you include everything? Because the answer that includes everything is the only answer that matters.